Good morning, everybody.
Good morning.
Thank you. We're going to talk about data. It's going to be exciting, yes? I have 15 minutes. I'm going to talk to you about the State of the Union the way we see it. I'm going to go rather quickly, as you can imagine. But the good news is all the slides are available for you, and I've heard I'm getting an actual physical hook if I go over, so that will not happen. But I want to start by saying it is such an honor and a pleasure to share the stage with Horst Schulze, a fellow German. Can't wait to hear your remarks. I've followed your career since I was this, and a few words, but a little bit older. But it's truly an honor to be on the same stage with you as you. What I would like to do is give you our State of the Union for the boutique hotel industry. I want to talk very, very briefly about how the US hotel industry is doing. I want to talk then about your specific sector and then give you our forecast, just 2 slides on that. As always, all the presentations are available on Hotel News Now. Ed Watkins is here in the 4th row. If you have questions about HNN or what the website is, it's right there. Ed can answer all those questions. So let's start with the United States the way we see it. This is the latest data available through April. Life is good. Thank you very much. That's really the tenor of the talk. It's been actually better than expected for the first quarter. Room demand, as you can see here, is increasing for the first 4 months, just under 4%, which is a little bit stronger than we would have thought. At the same time, very limited new supply. Everybody talks about the supply, it just hasn't happened yet. So that interplay between strong demand growth, limited increases in new supply then give you healthy increases in occupancy. And because our occupancies are now around 61% or so, that means we have pricing power. So room rates are going up around 4%, which is what's driving RevPAR. And that's the story for this year, for next year, for 2016. And then we'll see what happens with that new supply, and how that impacts pricing power. So overall, what I'm showing you here is the long view back to the beginning of time, according to Randy Smith, which is 1990. And what I'm showing you here is the interplay between how the changes in occupancy impact the changes in pricing. And again, what is interesting for me as a data guy is on the far right-hand side, you see what is a pink line, the occupancy percent change. We would have expected that percent change growth number to come down further, but you see it's sort of stalled out, and we see continued occupancy growth, which then will mean and translate into continued pricing power for the industry. So that's a really, really encouraging chart and encouraging signs, and we look forward to reporting basically the same thing next year. The question, of course, is always, Jan, how long does it last? And the answer is, I have no idea. But this is what the history is. What you're seeing here are RevPAR percent change cycles. How long was RevPAR positive? Was RevPAR growth positive? And you're seeing that, well, at one point it was 112 months. Then the last cycle took 65 months. We're now 44 months into it. How long is it going to last? I think a lot of you just attended the NYU Hotel Investment Conference at the Marquis for the last 3 days, and everybody's just giddy. So that's always a bad sign. If everybody's thinking the same way, somebody's not thinking. So we're all sort of in the consensus area that we're saying, well, 2 years, maybe 3, maybe a little bit longer, barring any black swan events. But so years or so, it should be pretty smooth sailing. So let's talk about boutique. I had dinner Monday night. 6 people, preferred person, hired person, couple of investors. And I'm like, all right, I have to talk about boutique. What does it mean? And so after an hour and a half, we asked 6 people, you get 8 opinions. So what's boutique? I'm not 100% sure. And then I asked Francis to send me a definition, which was this long. And also, that doesn't help me because I'm a black and white kind of guy. I'm a data guy. 0s and 1s is what I do. So I said, OK, boutique to me means right now this. You may or may not agree with that, but those are the slides I have, so I'm sorry. So what I'm saying is luxury class, upper end of the market with less than 200 rooms. I think you could sort of get your head around that. I know that your mileage may vary, and is the SLS Sahara Hotel in Vegas with 1,700 rooms, does that fit? No. Is it a boutique? Probably. They're trying to be. So there are obviously shades of gray. But just for the majority of the industry, let's just use this definition for the next 8.5 minutes. And what I'm showing you here is, again, for the first 4 months of this year, the performance. And it looks very much like the performance for the total US. Pretty healthy ADR growth driven by an occupancy that's 63%, which is driven by healthy increases in demand. So it pretty much mirrors what the US is doing, except that if you remember the ADR for the total US is $100 or so, and this is 300. Well, 280, but getting to be 300. So slightly different target market, slightly different customer, slightly different pricing power, but the fundamentals are pretty much the same. Demand growth is healthy, which gives you healthy rate growth. Then this is the quarterly RevPAR percent change for the last 3 years, and then obviously the first quarter. Keep in mind that Easter fell in a weird spot this year, so the Q1 number is all sort of funky. But in general, what you're seeing here is very, very, very healthy RevPAR growth in the past, and we're expecting that to continue. Obviously, the 2011 numbers were rebound numbers, so we don't expect to have double-digit growth every quarter going forward, but it was just nice to see that indeed there was a bounce. And then after that, RevPAR growth of around 6 to 7%. Yeah, I think we can all live with that, and I hope we can all make money at that point. This is the same chart that I had earlier, the interplay between occupancy and ADR percent change, basically just to show you, okay, there was a recession, turns out, and so occupancy declined, and at the same time, most people ran for the exits pricing-wise and decreased their ADR. We're now, luckily, we're back. Unfortunately, you see that the discount on the ADR side was -12, and we only rebounded, to +8, so we didn't quite make up what we lost, but luckily this is sustained. So if we increase our room rates year over year 5 over 5%, I think that's certainly a good thing. And it looks to me that this is going to be a boring next 2 years, smooth sailing, which you love. Let's be honest. The next two charts deal with the interplay between group and transient. So for the high end of the market, we're asking, is the room that you're selling sold in increments of 10 or more, what we call group, or increments between 1 and 9, what we call transient? And so what I'm showing you here is the demand and the ADR percent change for transient travelers in the boutique space. And I think what's interesting to note here is that the demand growth is very, very healthy and sustained, and at the same time, you're feeling really a lift in room rates. And you contrast to the last chart, which was sort of like a flat ADR percent change line. Here, I think there are more signs of life, and that is obviously driven by higher occupancies, by compression, and then you have just more pricing power. That's just the way the math works. And then flipping that over and saying, okay, how do we do with groups? Obviously, that's not necessarily 100% of your target market. Actually, in some instances, it's 0% of your target market. But some of you are dealing, with conventions, with associations, with smaller groups. The recession hit pretty hard, and what you're seeing is that demand bounced back. So it sounds like, as your occupancies declined, you said, well, we really don't want that customer, but at this point, we do want that customer. And so you're trying to target, and now as the occupancies are healthy and increasing, it's probably fair to say that the occupancy percent from group is declining. That's probably not a bad thing. That's your business model. You're focusing more on the transient side. There's very little signs of life on the ADR side, and it's going to obviously take a while. The group ADR that you're getting today was negotiated a year ago, so it's going to be interesting to see how you negotiate today for the group ADR, coming in 2015. I'm taking now a subset. So what I just showed you was total US. And now I'm switching gears and I'm saying, okay, let's focus on the top 25 markets, the coastal markets, just to see, is there something different? Is there more of the same going on? And as you can see, the answer is, well, the coastal markets, the top 25 markets are doing actually a lot better. That's where a lot of you want to be. That's where a lot of you are already. That's where the action is. The top 25 markets have roared out of the recession in 2011 and 12, and they're doing really, really well. What's interesting to see here is the supply percent change number. For the US, you saw the number, it's 0.8. Top 25 boutique properties, the way we define them here right now, 3%. You're no longer the only game in town, and you won't be. And if you open your back window, there's a crane, and somebody's building, and that's the story going forward. You know, I think the performance metrics that we put out to anybody who pays us, that's the way we work, you know, have shown, you know, that the boutique properties are doing really, really well, you know, or the high end, I should say, the high end, smaller properties are doing really, really well. And so therefore, then there's a lot of developers' attention, you know, and that's exactly what our data shows, and that's exactly what you're going to see, you know, in your specific markets, in your specific subsets. That said, right now, you know, while the hunting is good, 4.6% ADR growth, and I would do that now, and I would do that more, because eventually you're not going to be the only game in town. You know, there will be somebody opening, not next door, maybe next door, but down the block, down the road. Point is really of this chart. This is the supply percent change for those high-end properties, and you're seeing it that even through the recession, you know, I mean, yeah, it slowed down a little bit, but this is nowhere near the 0.4% annualized room supply growth that we saw for the US. You know, your segment is hot and will continue to be hot, which is awesome for you. It means that there's demand there, you know, but it also means that there's a lot of competition coming. But good news is this chart, this is about the most boring chart I've ever done, but it's so cool because it goes up, you know. And what you're seeing here is basically just the top 25 market boutique ADR. I call it single-mindedness, you know, because you have one purpose in this chart. It's like, yeah, drive rate. You know, if I was in your shoes, I'd do exactly the same thing, because supply is a-comin'. Let me finish up by telling you where we think the world is, what the world is doing. This is total US RevPAR percent change for last year, this year, next year. Robert will come up right after me and show you his forecast. He's a lot more bullish, which is sort of interesting because he's buying our data. You know, so they have a different macroeconomic model that suggests that RevPAR growth is, from our point of view, is healthy. In his point of view, is very healthy. So, you know, choose your poison. But we're saying, you know, RevPAR growth just under 6% for this year, 5% or so next year, and we're not projecting 16 or 17, but if I had to, it's going to be somewhere in the same, you know, ballpark. And then for the super high end, or not the super end, for the high end, you know, what we call the luxury end. These are luxury chains only, since we don't forecast the boutique market. It's basically the same, except it's better. So on the upper end of the market, because of you know, the pricing power that we're seeing that coming out of the recession, that's driving RevPAR for the foreseeable future. So I was more of the warm-up act. The real reason why you're here is Robert Mandelbaum from PKF, so give him a warm hand. Thank you very much for your time.